Welcome to the Atomic Level, the show where we decode the matters of wealth, one insightful conversation at a time with the rising stars in finance, business, and tech so that you can grow and protect not only your net worth, but also, more importantly, your net happiness. I am Chris Snook, back again today, despite the technical issues. Thanks, Substack, for all the upgrades, but man, we were stressing it in the green room. We are here 5 minutes late. Thanks for your patience. Thank you for hanging out and waiting and joining the room. Please share the stream. Restack it, do whatever you got to do. You are not going to want to miss the conversation I'm about to have starting right now with Jay Pelosky, who is rapidly climbing the charts, and we're going to find out why on the Rising Stars of Finance and Bestsellers, earning that orange check. Jay, welcome to the Atomic Level.
Chris, it's been a bit of a challenge, as you noted, but I've always said I'm a better investor in tech than I am a user of tech, and we just proved that again. But thanks for your patience and the patience of the audience, and excited to have this discussion with you.
Awesome, me too. And for those listening on replay, you didn't have to deal with any of that, so we're going to leave it in the past. Okay, so Jay, as you know, first thing we want to do is kind of who we listen to and why do we care, right? This show's really about humanizing the words, the wisdom, the advice, the vantage point by understanding who that human is, right? What shaped their worldview. So talk to us a little bit about, so we understand kind of your career arc. I don't know you other than our quick DMs to get this booked. And so I love learning in real time and taking the audience on that ride with me. But talk to us about your career path, your life path, kind of just what shaped your worldview.
Sure. It's a fairly lengthy story. So I love the idea, as I think I messaged you about the rising star, given that I've been in the business for close to 40 years. So it's pretty funny. It's been 40 years in the making, but we're here and we're happy to be a rising star. So I guess I would start, back early in the beginning of my career, where I was doing emerging markets in the late 80s, early 90s. I joined Morgan Stanley on the asset management side, the buy side, in 1990. And the first thing they asked me to do was to start a Brazil fund, even though I was a non-Japan Asian emerging market, quote unquote expert. So I spent a couple of years in Latin America. We launched the Brazil fund. We launched a regional Latin American discovery fund. And then I was asked to move to the sell side of the firm and serve as Latin American equity strategist and build out that research team. And that was great timing for the first of several, bear markets that I've been involved in, with the Mexican peso crisis, where I was ranked number one in II for LATAM research. And I had written a piece. I'd been on vacation, and I wrote a piece called Bear in the Woods. When you're camping and you hear rustling sounds outside your tent, you're always freaked out. And I was saying, hey, don't be freaked out. They're not going to devalue. And, things are good. Let's keep on going. 2 weeks later, got woken up in the middle of the night. Mexican government had just announced the maxi devaluation. And I was on the front page of the business section of the Journal as the poster child for Wall Street getting Mexico wrong. So I've had a few of those type experiences. I moved from LATAM research to global emerging market strategy at Morgan Stanley. And that is where I kind of marked the beginning of my global macro experience. So 1995 it was the firm's first multi-asset, so stocks, bonds, currencies, multi-regional, so LATAM, Asia, Europe, research product. And we did that for a couple years. I moved on to global equity strategy at Morgan Stanley. And then my last job there was to develop and run a global asset allocation strategy product, which was the firm's flagship research product that included everything. So not only all assets in all regions, but also all types of research. So fundamental, technical, quantitative. And you can just imagine, you get 30 really smart people around a room and you try to hammer out a point of view on the markets. And, what becomes pretty apparent pretty quickly is that, that view, that firm view, is basically the lowest common denominator. And so I did that for a couple of years, left Morgan Stanley in the early 2000s. And so from, I'd say, the last 20 plus years, I've been managing my own capital using ETFs pretty exclusively and basically replicating the asset allocation techniques and principles I and others developed at Morgan Stanley. More recently, now bringing us to about 2010, I started to get back into the business again, starting with the first version of what's now TPW Advisory. And it started really with writing about what I call the tripolar world. So TPW stands for the tripolar world. It was a thesis I developed about where the global operating system was going next, right? So the great financial crisis broke the globalization of finance. That was pretty clear. I argued that nationalism was not really going to work because no one has everything that people need. Brexit proved that point, 6 years later. And I was arguing that regional deepening or regional integration in the three main regions of Asia, Europe, and the Americas was going to be the way forward, as each region increasingly was able to do three basic things: self-finance, self-produce, and self-consume. And it's interesting that one of the pieces we just wrote last week, we talked about convergence and divergences around the globe. And I led off with work from McKinsey talking about how global incomes have converged to the tightest they've been across countries in the last 100 years. And so that idea of global convergence, global income convergence, really supports the idea of each region being able to self-finance, self-produce, and self-consume. You need wealth to do all three, right? And so McKinsey, I thought that was really a powerful kind of support for our thesis. And so that's really where we're at. TPW Advisory, as we think of it today, does several things. We provide investment strategy and asset allocation advice. We have our Substack, the Tripolar World, and we offer a model portfolio delivery service where we offer two models. One is our global multi-asset. So think stocks, bonds, currencies, commodities. Usually has about 30 ETFs in it, benchmarked 50% ACWI, 40% Barclays Ag, so bonds, 10% Goldman Sachs Commodity Index. And then the second is our TPW 20, so a thematic model, benchmarked 50% MSCI Future Innovation Index and 50% MSCI Alternative Energy Index. And that work in the thematic space has really been helpful in the last 6 months or so as thematics start to percolate a little bit more. And we use the TPW 20 as a feeding ground into the GMA. So the themes we really like, we put into the GMA. As I said, I think it holds about 30 positions. And that's really where we're at. We are, a long time in the business. We're humble. We've had lots of up and down markets, and we're excited to learn and see how the world is evolving. And we do feel strongly that the world is evolving towards a tripolar world.
So let's unpack. That's a good intro. Let's unpack that framework a lot more, though. Because I think you really gave us the great summary of the three kind of, call it outputs or things that are required. Self-finance. What was the middle one?
Self-produce.
Self-produce, and then self-consume, right? So that's kind of what allows you to be sovereign. That's what allows you to exist in a world, let alone a tripolar world, where you can kind of create some of your own destiny. You broke those three poles into Asia, Europe, and the Americas, basically. But let's think through that as far as the overall thesis. How much of what your theme is, or what that tripolar world framework is consensus validating against whatever norms others are out there, or contrarian to? And where do they cross? Because I'm assuming some of this probably finds some support from a lot of other people, but maybe not as loud. And then some of it's probably super contrarian, but I'm not clear yet on where those lines are. So let's unpack that a little bit.
Sure. I would say it's been considered quite contrarian, right? People talk about hegemony, where the U.S. is the world superpower. People talk about bipolar with the G2 of U.S. and China. And people talk about, Europe as kind of a forgotten place that never can get its act together. So I actually think that for the most part, the idea of a tripolar world driven by regions, not countries, is still very much far from consensus. And it's important to note regions, not countries, because arguably no country has everything it needs. The US has far from everything it needs. Look at the massive, imports that we do every year, right? China is far from having everything it needs. It imports a tremendous amount of food, natural resources, etc. Europe is probably the closest to having everything it needs within the EU, right? It's already got the region pretty fully integrated, but it's very, very slow moving and and doesn't really have the speed, particularly the speed necessary to, I think, be successful today. So when we think about the development of the tripolar world, we think about Brexit being kind of the first proof of nationalism not working, right? UK went on its own, thinking they could do fine, and 10 years later, we're now 10 years later from the 2016 decision to exit the EU. Everything you look at shows that the UK is poorer, less successful, less attractive, less appealing than it was 10 years ago. So that proves the nationalism point, I think. The whole US, environment the last couple of years with Liberation Day, with the Trump tariffs, immediately having to reverse itself because China said, sure, fine, you want to tariff us and not allow us to have semiconductors, et cetera, and charge 50% for us to import or export to you. We're not going to let you have any rare earths. Fine, great, done, right? U.S. backed down considerably. And so we had COVID in between. COVID really demonstrated the importance of supply chains, the importance of nearshoring, friendshoring, reshoring, all that type of stuff. And now we have tech and AI demonstrating the need to have your own sovereign AI stack. Again, very few people have everything that's necessary to put a sovereign AI stack together, but regionally, people can do that. You have the same thing with defense, right? All of a sudden, as a result of some of the actions of this administration in particular, Europe is finding it needs its own defense capability. Asia is finding it needs its own defense capability, right? What have we told Japan? What have we told Korea about delivery of Patriot missile systems? That we're telling them we have no idea when you're going to get the missile systems you paid for because we've used them all in Iran. So we really feel like the idea of a tripolar world is really critical to now bring it back to kind of how we use it. I think it's really important to understand that we've been thinking in a tripolar world framework for 15 years. Most of the rest of our competitors and most investors have been thinking pretty much solely about the US for 14 of those 15 years. And the reason's simple. It's because the US outperformed everybody else from the bottom in 2009 through 2024. So people didn't need to pay attention to China, to Europe, etc. Now they do, and they're coming to realize that. But we've been doing that every day. It's part of our DNA. So we really think that the tripolar world framework is critical to have some sort of framework to take a step back. To be successful in global macro investing, particularly today and in the future, I believe at least that people need a framework. You need some ordering system to put the world in context. You need some framework so that you don't get distracted by the latest, flashy object the latest dumpster fire. And the tripolar world serves as that framework for us and keeps us tethered. And so we spend as much time thinking about Asia and China as we do about Europe and Germany and Spain, as we do about the US, Brazil, and Mexico. And I think that really differentiates us. And it's the beginning of the first key for successful global macro, namely a framework. The second,
let me pause there.
Go ahead.
Interject a couple things because I want you to keep going. So I'm going to put a couple questions. You can answer them however you want. I just want to put them in there so you can keep going. This is an interesting conversation because actually I find myself really wanting to challenge the framework, and I know that you're up for that because I really want to understand. I want to look at this in a way that opens my mind, right, to a different bias. Because I think what you said up front was really grounding, which was self-finance, self-produce, and self-consume, right? That's really the three things that you look for. What Brent Johnson, who I had on a couple of weeks ago, dollar milkshake theory, whatever, right, would call relativity, right? The relativity strength is more important than the absolute strength because everything's relative in a moving, dynamic financial market, global world, geopolitics, everything else. So through the sense of relativity, I think your framework gives us three things that kind of put a score against, right? Like how good am I at self-financing? Well, you could argue Brexit. Like you could argue, hey, the pound is a strong currency. It's been around forever. It's not the reserve currency, but they could probably self-finance. You could argue that, right? You could argue that they could self-consume because high income, like they got a flourishing society in that way. I don't know what their unemployment rate was at the time. Don't know now. But point is, like, you could make an argument against that. Self-produce is where I would see them falling down and what, the big issue is, right? Because they need everybody else to buy the things that they need. And they're an island. You look at the dollar hegemony and you go, okay, there's all the things that we could say is wrong with it or not strong about it or whatever. But then you look at, well, can we self-finance? The answer is yes. We finance everybody. 60-some odd % of the world, right?
No, stop
okay,
right
good.
there.
So tell me why that's wrong.
Because foreigners own a huge chunk of our treasury market. If they didn't own our treasury market, interest rates would be significantly higher. Foreigners own 25% of the U.S. equity market. If it wasn't for foreign participation in our equity market, it would be distinctly different. So I completely disagree with the idea
that's a good point. But let's go there.
So the U.S. can self-finance itself. Just to finish, we have a 6% budget deficit. Mm-hmm. I mean, it's,
No, I want you to keep going on that. So that's great. So now we found a point where I was trying to get to, like, where's the thing where you would disagree and give me the reasons? So when you think of the U.S., we can't self-finance because the majority of our treasury market is owned by foreigners, not owned by our own citizenry. But there's a reason why they have to buy that. They're not buying that because they love us. They're buying that because they need what it provides. So talk about it through that lens and what could change that. In other words, their ability to self-finance is based on what? And why do they own our treasury if they don't need it?
We can talk about this. This is not, something that I'm really want to focus on, but if you want to focus on,
I just want to understand your framework so that
I think it's pretty straightforward, right? We in the U.S. have no capacity to live within our means. Thus, we run a massive budget deficit, 6% of GDP at a period of peacetime with relatively full employment. It's ahistorical.
Right.
And as a result of that, we're issuing tremendous amounts of treasuries, just absurd amounts of treasuries every year. And more importantly, we're now, because we don't want to pay the rate at the long end, we're issuing more and more treasury bills and short-term notes, which means the rollover is even faster, right? And so foreign investors have traditionally bought the treasury market and other U.S. assets as a way of recycling the dollars that they get from exporting to us, right? Because we run a massive trade deficit, trillions of dollars of a trade deficit. So when we import something, we pay in dollars, and the Koreans, the Chinese, the Europeans, the Germans, whomever, they get dollars and they have to do something with the dollars. And typically there's a recycling into treasuries and into stocks. And as I said before, for 15 years, the U.S. was the best performing stock market in the world. And so naturally it drew in capital. And now that's changing. And so the whole idea of convergence, the whole idea of China becoming a global competitor and even a global leader in many of the industries of the future suggests that this relationship is at risk of breaking down or declining or becoming less robust. And I think that's certainly, my point of view. I'm of the view that the U.S. has, as a result of the outperformance of the last 14 and 15 years, has now a significant valuation premium versus the rest of the world. It's priced at a premium, but its performance is at best average and at worst subpar, and would arguably should trade at a discount. So you think about US versus EM, emerging markets. Traditionally EM sells at a pretty significant discount, as it does today, right? US at 21 times forward earnings, EM at 12 times forward earnings. The global convergence that McKinsey spoke of is also manifesting through the globalization of earnings. So, for example, 2026 and 2027 for earnings estimates for the US and EM are roughly the same. You can argue, for example, that EM macro fundamentals are better than the US. EM run lower budget deficits. EM have lower inflation. EM has higher GDP growth. And yet it's priced at a 50% discount. One of the things I think is going to happen going forward.
Does that flow? No. I just want to interject this because I want clarity on EM. When you say EM, does that flow equally across those three regions that you're speaking about? Meaning, like, because there's you have India, right? You could call that over there in Asia, right? You have EMs in Eastern Europe. You have EMs in Latin America. When you speak about EM, are you seeing relatively parity between those macro factors in each of the three regions that you call tripolar, or are they different and why?
Yeah, I don't think about it that way. When I talk about EM trading at 12 times forward earnings, that's the emerging market index.
Okay.
So it's basically at this point, interestingly enough, at this point now, the top two markets are South Korea and Taiwan, which show you kind of where the action is, right, in technology. China, which used to be 40% or so of the broad EM index, is now the third biggest at like 19%. So Latin America, which back in the day when I was at Morgan Stanley, LATAM was 40% of EM. Today, it's less than 6%. So when I talk about EM as trading at a forward P, that's the broad emerging market equity index.
Thank you. I just want to understand.
No, good question. And so my main, a main thesis that, again, I wrote about in our monthly last week was this idea of a convergence of global income, which is allowing for global growth to converge, which is allowing for global earnings growth to converge, is signaling a significant medium to long-term opportunity that lies within the divergence between U.S. valuation and EM valuation. In other words, if we're converging, the valuation should converge. And as that valuation converges, I think it's going to converge in two ways. One, U.S. premium coming down because we're not we don't deserve the premium. And two, rest of the world valuation going up as they become better growers, better earnings growth. Because again, it's not GDP growth, right? We know that.
Right.
What drives stocks is earnings growth. And that's why I hang a lot on the hat of EM earnings growth in 2026 and 2027 is forecast to be roughly the same as US earnings growth. So you can buy the same earnings stream for a 50% discount. I'm going to do that all day long. So just to get back on topic a little bit, So as I think about it, and then we can get into this stuff again, but I just want to make the point to the audience that, to be successful in global macro, in my view, you need three things. One is a framework. We've touched on the tripolar world. We've discussed that. The second is a process. And so our process at TPW Advisory is to write. We write every Friday. We have our Friday musings on Substack. And I wrote, and I got that from Morgan Stanley as a sell side strategist at Morgan Stanley. We wrote every week. And I think that's a great way to, to kind of keep yourself on top of the information wave. Things are moving extremely rapidly. And, there's no value in talking about what happened, right? I think AI is destroying the value of what happened. It is putting a premium on the value of what do you think will happen. Mm-hmm. And so we do that by writing every week. And so we write a weekly musings every Friday, the first 3 weeks of the month, and then we write a monthly. And that monthly is a deep dive, typically 7,000 words. You have some nice things to say about some of the charts. Typically 30 or 40 charts.
It's a great plug to say, obviously, if you're listening to this on replay, give them a subscribe. It'll be in the show notes. If you're live, just click the button on your screen right now. Just, get into his orbit, because I have read, several of the pieces just before booking it. And, like the depth and the thought process and the writing is extensive. And so, you have my plug to go check that out, right? Like, you should go check that out and argue with yourself, just like I'm arguing with myself on some things right now as I listen to Jay. So you should. Yeah. All right, go back to
excellent. It. Yeah, no,
right on
great.
Fridays, and you.
Yeah, and just to give the audience a little bit more sense of our process. So I read most of the day. I spend reading. I occasionally talk to people, but mostly reading. And when I see a chart I like, we pull the chart, right? And when we're about to write the monthly, we put all those charts from the prior weeks into a chart book. And that chart book most months is between 350 to 500 charts. And we pull 40 or 35. So it's a distillation process, right? We're talking 10% of the charts that we look at, that we pull for a month. We look at triple, quadruple that number over the course of the reading. But we picked 40 or so charts. And then the idea is, Chris, that we get everything in our head, we get it all on the paper, and then the next week is when we update our models for our model portfolio clients. And so we update once a month, and we're doing that this week. Actually, this afternoon is our model portfolio meeting for this month. And then we update the models and send them out to our clients. And so it really is a process that allows us to have a framework that has a process behind it and then has a structure. The model portfolios are a structure. And so we're not just talkers, we're not just writers. And importantly, I think for folks to understand, the bulk of my own personal investable capital is in the global multi-asset model. So I know exactly what is happening to it. And I see it every day. And so I think our client and my interests are aligned. And I think that's also relatively rare, where the advice provider is actually invested in the advice he or she is providing. So I'll stop there. I just want to make sure people understood
I want to ask one more question. I want to one more question on the process that I know you have the answer to, but I think is relevant to the comment you made in the very beginning, which was when you were at Morgan Stanley, right? You had these similar meetings. I call it the model portfolio meeting today, but whatever it was, right? And you had 30 folks in there, and the view, the output, the view was the lowest common denominator of the 30, which means basically at some point 29 people gave up or whatever, right? So how have you put a process in TPW to prevent that?
It's very simple. It's pretty much me.
Okay. So you just remove 29 people.
Exactly.
And again, I love the honesty of that, because it doesn't really matter, right? The point is that was a constraint in you getting to something that you felt like you would put your own money into back in the day, Now you just clarified you've got your money riding on this for hell or high water. And so if people want to know whose view it is, it's your view. And the work that went into it was everything you explained. And your money's riding on that view. And so they can like that or not. But that's about as clean and as simple to understand as it gets. And I think that's an important part of that process is you built this process for you and your money. You're sharing it with clients who value that view for them and their money. Simple.
That's 100% right, though I would just quibble a little bit about the Morgan Stanley lowest common denominator view and putting my own money into it. We weren't allowed, you're not really allowed to do
Right.
that when you're on the sell side, so it's illegal. But in the lowest common denominator was a little bit of a knock, but not really. It's basically the idea of when you get 30 smart people who have, different areas of responsibility, they're all going to argue their area of responsibility, as it should be. Putting it all together and hammering out a view that people are kind of okay with is very tricky, because to have a view, you're going to disagree with somebody. And so I'm just saying that when you look at these big firms, and they have tremendous amounts of wisdom, and I get reports from pretty much the bulk of the big firms, a lot of them, they're of value, but just to understand that when you get a firm view, it is a view that has been kind of hammered into consensus, and it may not always, it's not necessarily contrarian, it's not necessarily the sharpest view, it's not necessarily going to be tremendously additive because of the process by which it was generated.
Mm-hmm. So maybe this is relevant, maybe it's not. And I say that just because if it's not, you can pass, right? And if it is, go nuts on it. Where in the framework or in the approach do you consider the demographic data as a macro force? You mentioned the emerging markets. We talked about the arbitrage there. Okay, that's what it is. You have exposure to it on a broad base. That's what it is. But some of the places that are kind of hitting numbers right now, like in other words, places that are like, hey, that Taiwan, like you mentioned, South Korea, they have the same issues we have here, that China has, that Japan has, that Europe has, right? You have a demographic issue where a lot of people are moving out of consumption, except for maybe healthcare, right? Like they're moving, like you have a large demographic issue over 60 in a lot of these places that have kind of built the world as we know it for the last 100 years. Then you have places like Africa, and you have Latin America, where you have a density of a couple billion people under 20 something, but not necessarily all the pieces in place to self-finance, self-produce because of any number of variables. Does demographics go into your weighted average in any way, in a meaningful way that isn't just obvious, or is it kind of like it's like a force, but everyone talks about it, and I don't think it's as relevant as people think because of X? Like, I'm just curious what you think about that.
Sure. No, I mean, we wrote some time ago about a new growth model. And we argue that the new growth model of today really has two key drivers. And the first is clean, abundant, renewable energy. And the second is an expanding labor force. Because when you think about GDP growth, there's two factors, right? One is labor force, and two is productivity. So, if you think about how to grow, and this is why, the US is growing at 2% is considered good growth, right? Because we're really, especially now, after the Trump administration's actions on immigration, we're not growing the population. So you're not going to really grow the economy. That's why Europe grows at 1% and is considered decent growth, because there's no real population growth. And so we actually have like two poster childs, we call them, for this view, and one DM, developed market, and one EM. The developed market is Spain, right? Spain was early in the adoption of renewable energy, and obviously it's got a lot of sun. And so it has a significant competitive advantage in terms of the power costs, which are an important issue when you're thinking about where to set up manufacturing plants. And so as a result, you see that China, as it's thinking about where to put its European production platforms, because it's being forced to produce in Europe as opposed to simply exporting autos to Europe. Spain has the biggest Chinese EV production platform. BYD, the biggest Chinese producer, is setting up a massive factory there. And CATL, which is the battery maker, is also setting up a factory in Spain. And so if you look over the last several years, Spain has by far the best growth of Europe, of the developed major economies in Europe. It has received double bond rating upgrades, and its stock market has massively outperformed the European average. The second factor that is driving Spain's success is its immigration policy. It is welcoming immigration and is expanding its citizenry by something like 1 million citizens between last year and this year out of a country that's 45 million people. And so that's a very significant increase. And now, granted, many of those immigrants are from other Spanish-speaking countries, particularly in Latin America and South America. But nonetheless, Spain has realized that in order to grow, it needs to expand its labor force, and it's choosing to do so by immigration. I believe, and this is very contrarian, I believe that we're closer to the end of the immigrant bashing across the developed economies than we are at the beginning. Now, Brazil is the EM poster child for this new growth model. It too has some of the some of the cleanest power generation of any country, anywhere, a lot of it hydro. And it too is becoming a place where China and other countries are setting up production facilities, in part because of that clean, cheap, renewable energy. And Brazil, as you pointed out, is one of those countries that's still growing its labor force through its own, natural population growth and birth rate. But that's increasingly becoming rare. So that's where we would focus on the demographics.
What about dry powder? You mentioned all the things that are broken when you're telling me why you disagreed with my earlier point, right? That I was making about the dollar, the dollar denominated debt and those kind of weighted things. And so when you think about capital allocation, rotation, what have you, and you think about the amount of dry powder that's out there chasing far too few places to put it. I know you've written about the AI CapEx trade. Feel free to comment on that. We all know how bloated those expenditures against forward-looking earnings that are paper losses that haven't even happened yet, that are accounting tricks and sleights of hands that, we all kind of know that it's not sustainable, but capital's allocating there because it's allocating there. Where does the dry powder either, contract, like maybe it just evaporates, or where does it move to in your framework? Where is it rotating now? Where is it not being seen but rotating aggressively? Who benefits? Why? All that. Just curious.
Yeah, no, that's that's a big one. But let me start by saying I believe there's just massive amounts of dry powder globally. If you think about the money market funds in the U.S., $8 trillion. Yes. If you think about savings deposits in China, it's on the order of, I think, $25 trillion. If you think about savings in Europe, similar numbers, in low-yielding savings accounts, absolutely massive numbers. So that just kind of to set the stage. But, here's how we're thinking about things. The work that we've done in the last couple months, we introduced a tripolar world spending supercycle. And I think this is really important for people to understand. Each of the three regions are spending aggressively, both public sector and private sector, in three main areas. AI, right? We talked a little bit about the AI, sovereign AI issue. Defense, we touched on that a little bit as well, and climate. And what has happened in the last couple months is that Iran has really fused all three of these together. If you think about AI and defense, right? I mean, Iran was able to force the world's most expensive, biggest, most powerful navy to sit 1,000 miles offshore because it feared the drone attacks. $2,000, $3,000 drones. Ukraine made the point as well, but Iran, I think, really hammered it home with its ability to close the Strait of Hormuz with a couple of drone threats. And then you look at climate and defense, and it's the same thing. What did Iran do? Iran was the best possible advertisement for clean energy that one can imagine, right? All of a sudden, solar, wind, nuclear that you have in your own country that doesn't have to transit thousands of miles, it isn't at risk of being blockaded, becomes not some woke, ideology. It becomes secure power. It becomes a defense national security issue. So in our view, we are in the very early stages of a multi-year massive spending supercycle, unlike anything we've ever seen. And so when we published our chart like a month ago, today roughly it's $8 to $10 trillion being spent across the three regions on those three: AI, defense, and climate. By 2030, estimates are something like $17 trillion per annum being spent across the three regions on these three issues. And so that supports what we have been calling since 2022 a global growth long cycle, basically arguing at that time that all the money that went into post-COVID is going to fuel a solid global growth environment. And that global growth long cycle in turn supports the global earnings growth that underpins a continued equity bull market across the globe. And so we are arguing as part of that you have an opportunity to shift focus away from just the US to the rest of the world through this global growth long cycle, through this tripolar world spending super cycle, and position in things like EM in other places like Europe. And then in particular, in the last couple of weeks, we've introduced what we call our TPW 2.0 thematic investment roadmap, where we're talking about the thematics that we think are going to drive alpha generation in the next couple of years, as very rapidly things like autonomy, things like robotics, things like biotech are really going to manifest in real time. And we want to be exposed and positioning to that.
So where and I may have missed this, so apologies. But in your two products, call it the model portfolio, products,
Mm-hmm.
where in the theme or where in the mix do commodities play a role in that asset diversification, and what things do you agree with that are out there now floating around the constraint being memory, because inference is more expensive than everybody thought and projected, and models can basically be knocked off now by China or whomever else after billions of dollars been spent building the frontier. And so, at the end of the day, though, bits are great. That's the future of the world. The economy is a token economy now. At the same time, atoms are necessary for their ability to exist. And atoms are also, by the way, what humans need. We can't go 3 days without water. We can't go 40 days without food without getting really sick. And so, and then energy drives it all. So where does that whole thing fit into your model construction, your thinking, your framework? How do you arrive at that?
Yeah, that's a great question. First off, we coined a phrase maybe, 6 months ago: the digital eats the physical. Without the physical, there is no digital, right? Without power, without copper, without aluminum, there is no digital. So we're big believers in a commodity secular bull market. We think we're at the very beginning. And so as we think about what we just talked about, a global growth long cycle supported by a tripolar world spending super cycle, it means to us that one of the takeaways from an investment perspective is that the top of the funnel, the asset allocation decision across the buckets of stocks, bonds, equities, and commodity stocks, bonds, and commodities is very simple, right? And basically, we are significantly underweight fixed income because of that spending super cycle, which is both public and private. And thus, you have all the major developed economies running significant budget deficits. Thus, their long duration bonds are going up in yield, right? And returning less in price. So they're in bear markets. That's going to continue. Absolutely no doubt about it, right? Because if you don't spend, then you have no AI stack. If you don't spend, you have no defense. And if you don't spend, your people are going to be dying from heat exhaustion because you don't have the ability to power the air conditioners. And so that to us anyway is a given. So we, as an example, and I'll just lay out the numbers, no big deal. As I said, the GMA global multi-asset model is 50% ACWI, 40% Barclays Ag, 10% Goldman Sachs Commodity Index. We are about 70 equity, 10 fixed income, and 20 commodities. So we take that big fixed income underweight, and we take that capital and we allocate it. And we allocate it to equities. And within that equity space is a heavy dosage of thematics. And that's where we're getting some of our alpha. The other place where we're getting alpha is in the commodity space, where we are exposed across the spectrum from oil to MLPs to copper miners to nuclear to clean energy, to wind to solar, etc. Now, we don't bucket the clean energy into commodities, just to be clear. Those are two separate things. But we are double weighted effectively in commodities versus our benchmark. And we have a pretty heavy allocation to clean energy as well.
So I got to ask you this question because I know we're coming into the final couple minutes. We could do this for another 2 hours. But I gotta get your take on this because I think you'll have an interesting one. Depending on which side of the bed I roll out of, I could argue 50% either way on this statement. Interest rates come down because spending has to continue. Interest rates stay or go up because spending has to continue. Fiscal dominance is here, regardless of where the fiscal dominance is coming from. So you pick your pole, right? You pick your country, you pick your region. Fiscal dominance is here for all the reasons that you said. I agree with that. Monetary policy is, to me, I don't know. I could argue either direction. Where does that factor in? Because the entire monetary supply, as we know it, of fiat right now, regardless of your currency of choice, is tokenized debt. You already spoke to the problems we have here with out of control debt, to like these short-term rollovers, all this stuff. Are we in a stagflation environment for the next 10 years, even though you're long global growth? What happens?
Yeah, well, for us, no, we're not in stagflation. We're in a global growth long cycle that is going to generate significant earnings growth, which is going to allow stocks to continue to outperform. And I think it really is a nice setup to something I wanted to make sure we touched on, which I think there are kind of two things that are very different today than kind of even the recent past, even 2 to 3 to 5 years ago. And I want to make sure we touch on them. And the first is this idea of earnings growth, right, being much more robust and sustainable than has typically been the case. And it's creating this environment that because earnings growth is growing faster than stock markets are going up in many cases, you're actually buying stocks cheaper, even though they're higher than was the case previously. And that's something that it's really hard for people to wrap their heads around. And I think is really important to do so. And so when you think of something like NVIDIA, okay, the poster child for AI, NVIDIA today trades at like a 20 to 30% discount to its trailing 3-year PE multiple because earnings are growing so fast. And I think that's really important for people to kind of try and grasp and understand and think about, because if you think that stocks are overpriced, they're not. Stocks are at 21 times earnings with earnings growth of 20%, you're paying 1 times growth. That's not expensive at all. And so that suggests you should stay invested. And that leads me to the second point, and not sell off because you think things are too expensive. That leads me to the second point, which is that the discounting mechanism of the market today is much faster than it has been in the last couple, again, 3, 5, 10, 15, 20 years ago. And it's in large part because basically the day-to-day action in the market today is mostly model driven and algo driven, and they all have the same model and they all have the same levels buried in them as well. And that's why you see, as we saw with the Iran sell-off, now a couple of months ago, it was 10% and it happened in 2 weeks and it was over. If you think about the Liberation Day sell-off in April of 25, that was bigger, close to 20%. But again, in a matter of a month or so, it was done. And so markets discount much more quickly today than they have. And so as an investor, it requires you to do one of two things. You can try to trade with the algos and, sell at the top and buy back at the bottom, even though that's could be within 2 weeks.
Right.
And most of what you'll be reading does not suggest you should be buying at that bottom. Or you can say, I'm going to stay invested. I'm going to be focused on my main themes and my framework, and I'm going to ride through the volatility, even though it can be quite stomach churning. And so you need conviction and you need a strong stomach, but you've got to make a choice, one or the other, because this is the environment we're in. And it's not, that's my view, but it's also, we quoted Morgan Stanley in the monthly last week, where they have a market sentiment indicator that typically the average period between flipping from bullish to bearish in the 2023 to 2025 period was about 230 trading days. You know what it was in the Iran sell-off? 18 days. Mm. You know what it was year to date in 2026? 25 days. So 10% of what it was in the 3-year average 2023 to 2025. And I think that's much more what we're going to face going forward than, and so what that is shorter, sharper market pullbacks and corrections, which clear off the froth. Yesterday was a very good example in the tech space, clears out the froth in fewer longer drawn out bear markets, because you don't get the buildup of the froth that requires a massive 20-30% clean out to self-correct it. And I think those are really, really important things, and particularly important when you think about the thematic space, which again is, I think, where investors should be allocating some capital and certainly some of their thinking time. Who is going to lead in autonomy? Who is going to lead in humanoid robotics? Who is going to lead in biotech, in clean energy? Well, clean energy it's already done. It's already China. But those are areas where we think it's important to be participating in, but it's also very, very short and sharp and fast. And so that's where technicals, just to finish the point, sir, sorry. Yeah, and that's where we spend a lot of time. I mean, we're global macro and we're fundamental based, as we would call ourselves. But we spend a lot of time looking at technical charts. Mm-hmm. I spent this morning and most of yesterday afternoon looking at every single position we have in both of the two models, every single benchmark position, and anything that we're thinking of adding to either model, and running the technical charts, because it really helps, kind of think about how to move within the thematic space. And I'll give you just one real fast example. JEDI, JEDI, which is the autonomous warfare ETF. It went up about 50% during the April-May period with the whole Iran thing. And it's given back 35% of that. It's down now 35% from its high, and it's right back to its 100-day moving average. And we have a little shorthand, which is that anything that is 15% or more above its 50-day moving average, we tend to either sell out completely or reduce the position because that's a spike and it's going to come back down. And that was what helped us take our position down in JEDI. We cut it in half last month, and that saved us from, taking a 35% pullback on the full position. So I think those things are really important.
Yeah, as we kind of summarize it up, and I want to thank you again for joining the Atomic Level today and sharing with us your vantage point. I could say of all the interviews, I think this is the 40 some odd one, maybe 42, I can't remember, that we've done on the lives. And I've enjoyed all of them. All of them are smart people. Most of them expanded my thinking in multiple ways. You're the most challenging. You've challenged my thinking in the most ways, and I appreciate that uniquely about you. I'll remember this episode because I don't know that I agree with everything said, but I definitely know I'm thinking about it and I'm trying it on. And I think that's the point for the audience, right? That's the point for the audience is the knee-jerk reaction or the bias that we have is obviously well-formed, just like yours is. And when you can have a thoughtful conversation or listen to one, maybe you reconsider. You look at things in a different way, and it's not black or white. There's a lot of shades of gray in there. I want them to subscribe to you. I want them to put you into their mental fodder, so please do that. If you guys don't mind, please do the obvious stuff. I hate saying like and subscribe because it drives me crazy because I'm not 20. But hit the heart thing because it helps the algo remember that people cared about this and you tuned in and gave us time. Hit the restack thing. Somebody needs to hear what he just said and think about it themselves. Somebody needs to read his stuff that doesn't know yet. So if you're replaying, do that for me. And then most importantly, I think this one might have the most comments, and I hope it does because I hope people argue in a productive way. I hope we take this one off the 45, 50-minute interview and we bring it into the lexicon of discourse underneath it in the comment section. So please leave a comment, especially when the replay drops on this. We watch it again. I'm going to have to actually rewatch this one because I got to rehear some of this stuff you said. And we'll have to have you back sometime in the future. But the Tripolar World, you can read them on Substack, guys. Jay Pelosky, thanks so much for being here on the Atomic Level. I'll let you say a parting word, and then we will call it a show. And I'll see everybody else at 10 a.m. when we do Matt Chats for the AMA on asset protection and estate planning, because no matter how much money you make with guys like Jay, got to hold on to it. So I'll see you back here in 20 minutes on another live. But Jay, final word to you. Thanks for being here.
Great. Well, thank you, Chris, as well. And I have to say, you challenged me as well, and that's great. I've done this for a lot of years, so I tend to have my kind of spiel laid out, and you forced me to kind of shift gears a little bit, which is great, and I appreciate it. And look, global macro is a rich space. There's a ton going on. All I would say is that folks really need to look outside the U.S. There's an absolutely tremendous secular change going on, in my opinion. And even if I'm wrong, you're buying something, the same earnings. I go back to what I said earlier. You're buying roughly the same earnings growth stream that you can get in the U.S. outside, in Europe, in Japan, in emerging markets at roughly a 40 to 50% discount. And that discount is unlikely to last forever because the markets will recognize it and will sniff it out. And I would just simply say in closing that EM equity has outperformed the U.S. massively over the last 18 months. It outperformed significantly in 2025 and is outperforming significantly in 2026. The broad EM index, EEM ETF, is up about 20% year to date. The S&P is up 8%. So there are opportunities elsewhere. And just one more point, markets rotate. The best performing segments right now are banks, industrials, and small caps. I would just ask, how much do you have in small caps? Small cap IJR is up 20% year to date. S&P is up 8. Thank you.
Awesome. Well, thanks for being here, everybody. Jay, thanks again. We'll see you guys next time.